The world's largest primary silver mining company just handed you the most important number in the precious metals market right now. Not the COMEX spot price, not the gold to silver ratio, not the CPI reading dropping tomorrow morning. A single production number buried in a corporate report that almost nobody in retail finance has connected to the silver price sitting at $84 on your screen right now. That number is 47.58 million ounces. That is how much silver Fresnillo plc, ticker FRES on the London Stock Exchange, the single largest primary silver producer on planet Earth, produced in full year 2025, down from 56.3 million ounces in 2024. A 12.3% collapse in annual production from the company that sits at the very top of global silver supply. And here's what makes that number the most important data point in this market right now. Fresnillo did not miss their production target because of a labor strike. They did not miss because of a flood or an earthquake or a temporary processing outage. They missed because the ore grades at their flagship mines are in structural decline. The easy silver is gone. What remains is lower concentration material that requires more energy, more water, more diesel, more time, and more capital to process into finished ounces. And they just told the market that 2026 guidance is 42 to 46.5 million ounces, not a recovery, another step down. OG John AG here. This is financial warfare education, not advice. That means we go through both sides. We are going to look at exactly what the Fresnillo production report means for the global silver supply picture. We are going to look at the cost math that follows directly from declining ore grades in a 119 oil environment. And we are going to be completely honest about what this means, what it does not mean, and where the bear case actually lives. Because there is a real difference between understanding a structural supply shift and reacting to a single corporate filing on a Tuesday morning. Let me show you what the data actually says. Segment 1, Confirmed Facts, March 10th, 2026. Let me start with confirmed facts as of Tuesday, March 10th, 2026. Because separating confirmed from interpretation is the single most important discipline in a market this volatile. Confirmed. Silver is trading at $84 and change per ounce this morning, down from an all-time high of $121.62 reached in January 2026, up from the intraday low of $83 printed yesterday during the algorithmic sell-off that hammered futures from $87.90 at the Asian Open down to $83.04 in less than 90 minutes. Confirmed. Gold is trading at approximately $5,139 per ounce. The gold to silver ratio sits at approximately 61. Confirmed. Fresnillo plc full year 2025 silver production, 47.58 million ounces, a 12.3% year-over-year decline from 2024's 56.3 million ounces, confirmed in Fresnillo's official production report released in early 2026. Confirmed. Fresnillo's 2026 production guidance, 42 to 46.5 million ounces, another projected decline from 2025 actual output. Confirmed. The primary driver cited in Fresnillo's own reporting, lower ore grades across multiple operations including their Fresnillo, Saucito, Ciénega, and Juanicipio mines. This is not a temporary operational disruption. This is a geological progression the company has been flagging in quarterly reports throughout 2025. Confirmed. COMEX registered silver, the metal actually available for physical delivery against futures contracts, stands at approximately 86 million ounces. On first notice day for the March contract, delivery notices were issued for 10,526 contracts, representing 52.63 million ounces, more than 60% of total registered inventory demanded on a single day. Confirmed. COMEX registered inventory coverage ratio, 14.4%, paper leverage against registered inventory, 6.9 to 1. Registered inventory declining at approximately 785,000 ounces per day. Confirmed, Brent crude oil is trading near $119 per barrel, WTI near $116, both up approximately 38% from levels 6 months ago. Those are the confirmed facts. Everything after this is analysis. I want to be completely clear about that distinction before we go any further. Segment 2, the ore grade problem. Why this is structural, not cyclical. Let me explain what ore grade decline actually means at the operational level, because most retail investors hear the phrase and move on without understanding why it is the most consequential variable in the long-term silver supply picture. Ore grade is the concentration of silver in the rock you are mining, expressed in grams of silver per metric ton of ore processed. When Fresnillo developed their flagship Fresnillo mine, the operation that gave the company its name and helped make Mexico the largest silver-producing country in the world, they were working with exceptionally high-grade ore. Rich veins, dense silver concentration, efficient extraction. The physics of a high-grade mine are favorable. You move less rock, burn less fuel, consume less water and chemicals to produce each finished ounce of silver. What Fresnillo is reporting now across multiple operations is the geological reality of mature mining districts. The high-grade zones have been systematically mined over decades. What remains are lower-grade peripheral zones, narrower veins, and deeper deposits that require significantly more material movement per ounce of silver produced. The company's own reports describe it directly: narrower veins and increased dilution reducing ore grades, higher proportion of extraction from lower-grade zones, lower volumes processed from high-grade areas as those sections are depleted. At Saucito, ore grades declined approximately 10% in Q1 2025. At Ciénega, lower grades and reduced recovery rates persisted through multiple quarters. At Juanicipio, lower ore grades through 2025, despite that being one of Fresnillo's newer large-scale operations. And this is not a Mexico-only problem. The World Silver Survey 2025 confirms that primary silver supply, mines where silver is the main product, not a byproduct of copper or zinc extraction, has been on a long-term structural downward trend globally. Primary mines produced 227.5 million ounces globally in 2024. That figure has been declining as high-grade primary deposits are depleted and replacement discoveries become harder to develop economically. When the largest primary producer in the world guides to 42 to 46.5 million ounces in 2026, another step down from an already lower 2025, the data is telling you something specific about the direction of primary silver supply that no futures contract currently reflects. Segment 3. The cost math. What 199 oil does to a declining ore grade mine. Now let me connect the ore grade story to the energy cost picture, because this is the combination that makes the production math genuinely serious. Mining is an energy-intensive business. For a large-scale silver operation, energy costs, primarily diesel fuel for haul trucks, grinding and crushing mills, ventilation, and processing circuits, represent approximately 30 to 35% of total all-in sustaining costs. When ore grade at a mine declines, the energy consumption per ounce of silver produced increases in direct proportion. If your ore grade falls 25%, you must process 25% more material to produce the same amount of silver. Your haul trucks run 25% more hours. Your crushers and grinding mills operate 25% longer. Your diesel consumption per ounce produced rises by approximately the same proportion. Now overlay that dynamic with a crude oil price that has moved from approximately $70 per barrel to $119, a 70% increase in energy input costs. Here's the arithmetic. The average all-in sustaining cost for a mid-tier silver miner when oil was at $70 was approximately $22 per ounce, energy representing 30% of that cost. A 70% increase in energy input costs, representing 30% of total cost, translates to approximately a 21% increase in all-in sustaining costs from the energy factor alone. That takes the $22 baseline to approximately $26.60 per ounce before any ore grade adjustment. Now add the ore grade effect. If a specific operation has seen ore grades decline 13 to 25%, as Fresnillo has reported across multiple mines, the additional material processing required adds conservatively another 15 to 20% to the per ounce cost structure. When you combine both factors, you arrive at all-in sustaining costs for affected operations in the range of $30 to $35 per ounce. At first reading, $84 silver against a $30 to $35 all-in cost sounds like comfortable margin. And for the most efficient large producers, it still is, for now. But here's the critical detail. The companies at the margin, smaller primary silver miners operating older assets in higher cost jurisdictions, are not working from the large producer cost structure. They were already at $40 to $50 per ounce all in before the oil spike and the ore grade deterioration. For those operations, the math has already turned negative. And when marginal producers cut production or suspend operations, global supply does not partially decline. It falls immediately and permanently for the duration of that suspension. Segment 4, the COMEX picture. 6.9 paper claims for every physical ounce. Let me connect the mining supply story to the exchange mechanics, because the Fresnillo data point is not arriving into a stable, well-supplied market. It is arriving into a COMEX system already under delivery stress that this exchange has not seen before. COMEX registered silver, the metal specifically designated as available for delivery against futures contracts, stands at approximately 86 million ounces. Paper leverage against that registered inventory, 6.9 to 1. Nearly 7 ounces of paper claims for every 1 physical ounce that is actually deliverable. Coverage ratio, 14.4%. The registered inventory can satisfy delivery demand on approximately 14 cents of every dollar of paper exposure, Below 15% is considered stress territory by market historians. This market is sitting directly on that line. Registered inventory decline over the past 30 days, 20.7%, 21.3 million ounces withdrawn from the deliverable pool in 1 month. At the current withdrawal pace, the registered inventory would be exhausted in approximately 80 trading days if no new metal enters the system. The February 2026 delivery period set records. 5,036 contracts, 25.18 million ounces, delivered in a single month that is historically a minor delivery period, the highest February delivery volume in modern COMEX history. And when first notice day for March arrived on February 27th, 10,526 contracts stood for delivery immediately. 52.63 million ounces of demand against 86.13 million ounces of registered inventory. More than 60% of available physical metal demanded on day one of a single delivery period. Now add the Fresnillo 2026 production guidance. The largest primary silver producer on Earth just told the market they are producing less metal next year, not flat, less. The pipeline feeding global silver supply from primary production is contracting at the same moment the COMEX registered inventory is draining at record speed. Two forces, both moving in the same direction simultaneously, neither reflected in the $84 paper price. Segment 5, the global deficit, 5 years of math coming. Do let me put the Fresnillo report in the broader context of where global silver supply and demand have been moving. The Silver Institute's World Silver Survey 2025 confirmed that global silver demand has exceeded mine production for 5 consecutive years. The cumulative deficit over that period is measured in hundreds of millions of ounces, physical metal that had to be sourced from above-ground inventories and secondary sources rather than new mine production. Global silver demand in recent years has been running approximately 1.2 to 1.3 billion ounces annually. Global mine production has been in the range of 800 to 820 million ounces. The gap must be filled from stocks, and those stocks are being drained. COMEX registered silver inventory is down sharply from its 2020 levels. Shanghai Futures Exchange silver inventory fell from 559 metric tons in November 2025 to 318.5 tons in February 2026, a 43% decline in 3 months. The industrial demand consuming that silver is not slowing. Solar panel manufacturers require silver paste for electrical contacts with no economically competitive substitute. The solar industry alone is consuming over 130 million ounces per year and growing at approximately 15% annually. Electric vehicles consume significantly more silver per unit than internal combustion vehicles. The 5G build-out, AI data center expansion, and defense electronics manufacturing all add incremental demand, and the supply response that commodity markets rely on for rebalancing, higher prices incentivize more production, market returns to equilibrium, faces a structural limitation in silver that most commodities do not. Opening a new silver mine from discovery to first production takes between 7 and 10 years. Permitting, environmental assessment, capital construction, commissioning, none of that timeline responds to a price signal. You cannot mine silver that has not been permitted and built yet. The supply response that should arrive in response to $8,400 or $120 silver is not coming on a timeline that helps the current deficit. The Fresnillo guidance for 2026 is one confirmed data point in a multi-year structural pattern. It is not the cause of the silver thesis. It is confirmation that the thesis is playing out on schedule. Segment 6. What Asia is telling you while Western markets process. This let me add the geographic dimension, because while COMEX registered inventory drains and Fresnillo reports declining output, the physical market in Asia has been sending a consistent signal for months. The Shanghai Gold Exchange has been trading physical silver at a persistent premium to international spot prices. In recent weeks, that premium has been running in the range of $8 to $13 per ounce above COMEX levels. A premium of that size and duration is not a temporary arbitrage opportunity. It is a physical supply constraint signal. Metal is being priced higher in the region where industrial demand is most concentrated because the market is telling you supply there is insufficient at COMEX prices. China has also restricted silver exports, having reclassified silver as a strategic material. The global arbitrage mechanism that would normally equilibrate regional prices, buy cheap in the West, deliver to the East, is operating under regulatory friction. When Eastern buyers are paying $8 to $13 more per ounce than the paper price shows, and Western COMEX registered inventory is being drained at 785,000 ounces per day, and the largest primary producer just guided production lower for the second consecutive year, the paper price of $84 is not accurately describing the physical market. The gap between paper and physical does not stay at $84 indefinitely. Either physical supply increases enough to satisfy demand at that price, which the Fresnillo data says is not happening, or the paper price moves toward where physical supply and demand actually clear. Segment 7, the honest bear case. Now the other side, because this is financial warfare education, and the bear case deserves full intellectual respect. Bear argument 1, the production decline is within guidance. Fresnillo produced 47.58 million ounces against a guidance range of 47.5 to 54.5 million ounces. They hit the bottom of their range, not a catastrophic miss. The 2026 guidance is a step down, but Fresnillo has navigated declining grades before and maintained operations. Catastrophizing one annual production report as structural collapse overstates what the data confirms. Bear argument 2, gold revenue compensates. Fresnillo's 2025 gold production exceeded guidance at 585,000 ounces, above the top end of prior forecasts. With gold at $530 and representing approximately 42% of Fresnillo's revenue, strong gold prices offset declining silver volumes in the company's financials. Fresnillo is not in financial distress. They are a profitable operation adjusting mine plans in accordance with geological reality. Bear argument 3. COMEX has managed delivery stress before. The exchange has tools, margin hikes, emergency cash settlement provisions, position limits. COMEX has never defaulted in its history. Elevated delivery demand and falling registered inventory create stress. They do not automatically create failure. The exchange has demonstrated repeatedly that it can manage delivery pressure through financial tools even when physical tightness is real. Bear argument 4. Oil could reverse. The $119 Brent crude price reflects a geopolitical premium from the Iran conflict and Strait of Hormuz risk. If those situations de-escalate, and history says geopolitical oil premiums frequently do, energy input costs for silver mining ease. The cost math I walked through depends on oil staying near 119. It does not apply at $80 oil. I want to be direct about these arguments. They have real validity. The bear case has substance. Anyone sizing a position in silver exclusively on the Fresnillo report is working from an incomplete analysis. What the bear case does not change is the direction. Even in the most favorable bear scenario, oil reverses, COMEX manages delivery, Fresnillo stabilizes output, global primary silver supply remains in multi-year structural decline. The 5 consecutive year demand deficit does not resolve because one quarter's numbers came in at the low end of guidance. The industrial demand does not slow because energy prices ease. The bear case changes the timeline and the magnitude. It does not change the direction. Segment 8. 3 scenarios. Honest probability. Assessment. Let me give you 3 specific scenarios with honest probability assessments. Scenario 1. Managed transition. Fresnillo's 2026 guidance proves conservative and actual production comes in at the high end of the 42 to 46.5 million ounce range. New projects from other producers partially offset the primary supply decline. COMEX registered inventory stabilizes as rising prices incentivize metal holders to register eligible stocks for delivery. Oil eases from $119 toward $90 as Middle East tensions partially resolve. In this scenario, the silver price finds support in the $85 to $100 range. The structural deficit continues but does not accelerate. Gold to silver ratio compresses gradually from 61 toward 50 over the next 12 to 18 months. $150 silver is a 2027 story, not a 2026 story. This is the most optimistic short-term resolution. Note what the floor of this optimistic scenario looks like. Silver at $100 on de-escalation. Scenario 2, accelerating supply contraction. Fresnillo's operational challenges persist. Other primary producers report similar ore grade issues across their operations. COMEX delivery stress continues at elevated levels through May and July 2026 contract cycles. Oil stays elevated above $100 due to sustained Hormuz risk. In this scenario, industrial users who cannot source metal at spot prices begin entering long-term supply contracts directly with miners, bypassing COMEX. The paper price faces increasing pressure to converge with physical reality. Silver moves toward $120 to $150 within 2026 as the gold to silver ratio compresses toward 40. This is my current base case. Scenario 3. Structural inflection. The supply contraction accelerates faster than Scenario 2. Additional primary miners announce production cuts as the combination of declining ore grades and elevated energy costs makes marginal operations economically unviable. COMEX registered inventory drops below 60 million ounces. Industrial users actively competing for physical supply. In this scenario, the paper price cannot remain anchored below physical realities indefinitely. The gold to silver ratio compresses toward 25. $280 is not a theoretical ceiling. It is the arithmetic result of gold at $7,000 and a ratio at 25. Levels this ratio has reached in every major silver bull cycle over the past 50 years. Scenario 2 is my base case. The Fresnillo data confirms a trend that has been running for years. It does not create that trend. Segment 9. What to actually watch from here. Here's your specific watch list. All public, all free. Tomorrow morning, March 11th at 8:30 a.m. Eastern, February CPI, the most immediate market-moving data point. A soft print removes dollar pressure and allows the structural silver story to express itself in the paper price. A hot print keeps the ceiling on, while the physical reality continues building underneath it. Fresnillo full earnings commentary at fresnilloplc.com Investor Relations. The production numbers are confirmed. The all-in sustaining cost breakdown and forward capital expenditure guidance will tell you exactly how severe the margin pressure is at current energy and ore grade conditions. COMEX registered silver daily report. If registered inventory continues declining below 86 million ounces towards 70 million, while April and May open interest remains elevated, the delivery stress from March is compounding, not resolving. Shanghai Gold Exchange Silver Premium. If the $8 to $13 premium over COMEX narrows significantly, physical supply stress in Asia is easing. If it holds or widens, Eastern buyers are still consistently outbidding the paper price for real metal. Other primary silver producer quarterly updates. First Majestic, Kerr Mining, Hecla. Check their most recent production reports for ore grade trend language. If the grade decline Fresnillo is reporting appears across the primary producer universe, this is not a single company story. Online dealer premiums. JM Bullion, APMEX, Gainesville Coins, SD Bullion. If premiums on American Silver Eagles are running $8 or more over spot on a sustained basis, the retail physical market is already pricing in a supply picture the paper market has not acknowledged. Outro. I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. Here's where the data puts us on the morning of Tuesday, March 10th, 2026. The paper market says silver is $84 and change. The world's largest primary silver producer just reported a 12.3% production decline in 2025 and guided to another step down in 2026, citing structural ore grade deterioration at their flagship mines that cannot be reversed by a price signal on a futures screen. The COMEX registered inventory is being drained at 785,000 ounces per day. The coverage ratio sits at 14.4%. Stress territory. 6 days of that withdrawal pace exceeds the entire monthly output of a mid-size silver mine. The global silver deficit has run for 5 consecutive years. The industrial demand consuming that silver, solar panels, electric vehicles, defense electronics, AI data infrastructure, is not slowing, and the mines that supply primary silver are reporting the same geological reality from Mexico to Australia to Bolivia. The high-grade deposits that built this industry are depleted. What remains costs more to mine, more to process, and produces fewer ounces per ton of rock moved. None of that changes because the paper price is sitting at $84 today. The paper price and the physical reality are in disagreement right now. They are always eventually forced to speak to each other. Every data point this week, the Fresnillo production report, the COMEX delivery stress, the Asian physical premium, the oil price, is telling you which one moves to meet the other. This is financial warfare education, not advice. Pull the Fresnillo production report yourself. Read the ore grade language in their quarterly filings. Check the COMEX warehouse reports. Watch the physical dealer premiums. And never confuse what the paper market says silver is worth with what it actually costs to pull it out of the ground and put it in your hand. Drop OG John AG in the comments and tell me, does the Fresnillo 2026 guidance change your timeline on silver, or does the supply story just get stronger from here? I am reading every comment. OG out.